Hello and welcome to what is going to be the second to last lecture of the semester. So it's hard to believe that we've gotten this far, but we've got this lecture here and then one more, and then that'll be it for the rest of the semester. Today's lecture is on corporate performance, governance, and business ethics. And as someone who studies business ethics and has thought a fair amount about it, this is always a tricky lecture for me to give, in part because there are a lot of things in how we typically, or kind of the dominant understanding of business ethics and corporate governance that I have a little bit of a different perspective on. So what I've decided to do is, given that the textbook explanation of these topics is the dominant model, I thought we would start with simply presenting what the textbook talks about, and then save some of my thoughts to the end of lecture. But before we get into that, a few housekeeping things for y'all. Quiz 12 is going to be due April 19th at 5 p.m. Quiz 13 is due the 26th, and the 14th is due May 3rd. I've already opened the last two quizzes of the semester, so if you're ambitious and interested in finishing up a bit early, you're free to do so. As I just mentioned, we only have one more lecture after today. My understanding is the Tuesday of next week of Easter weekend, there are no classes, so I'll probably record the lecture in the second half of the week, but the lecture is for quiz 14, so even if I release it a bit late, you guys should have plenty of time. Also wanted to let you guys know I have struggled a bit to keep on top of grading for current events, and so as part of that, what I've decided to do is that you have until April 30th to submit your current event write-up. If you missed your presentation date, I will accept the recorded presentations of current events also through the 30th. So any current event that is submitted by April 30th will be counted as on time. And I'm going to close the current event submissions on April 30th, so that way I have some time to grade those before the exams come in and I have to submit grades. Along with that, as we talked about in the last lecture, what I've decided to do for case 3 is allow for resubmissions of your case 2, the Skullcandy case. And it was also mentioned in the face-to-face class earlier this morning. Someone asked if they could resubmit case 1. And so I'm fine with that. If you would like to resubmit either case 2 or case 3 for your third case, and then those will replace the grades for those. But you can only submit one of the two cases, so I won't accept, you can't resubmit both case 1 and case 2, but you can choose to resubmit either case 1 or case 2, and those are going to be on Tuesday, April 30th at 5 p.m. So the resubmissions for the presentations or the reports are both going to be due April 30th. And then exam 3 is going to be the same format as the last two exams. So it's going to be an online exam where you've got 2 hours to complete it, 50 multiple choice. I'll have 5 essay questions, and you choose from 3. You choose 3 of those to answer. The only difference is that because there are fewer chapters, we'll have more multiple choice questions from throughout the semester. And my idea for that is to open that on May 1st and close it on May 8th, giving you about a week to take the exam. As always, if there are any questions about the course, please feel free to post your questions on the student question lobby on the As You Learn, or contact me via email. So for today's class, we're going to be talking a little bit about this idea called stakeholder theory, which is an idea that I've spent a fair amount of time thinking and writing about over the last couple of years. We're also going to be talking about agency theory and agency problems and the conflict between agents and principals. We'll talk about different governance mechanisms that exist to address some of those agency problems. Then we'll finish up with the ethical issues and strategy before we get into some of my own thoughts on some of these topics. So let's get into it. So stakeholders and corporate performance. In 1984, a guy named Ed Freeman, a faculty member, a professor at the University of Virginia, published a book called Corporate Stakeholders, or Stakeholder Theory. And the idea behind Ed Freeman's book is that firms are responsible and respond to far more different kinds of interest groups than had previously been explicitly identified. That the model before Ed Freeman came around was dominated by this idea that firms work with suppliers, they do some work with, and then they sell the product to customers. And so, the model was very linear in terms of where a firm fell in the value chain. But what Ed Freeman noticed was that firms are responsible or respond to a much larger group of interests. That they respond to public opinion, that they can be affected by government regulation, that nonprofit organizations, and so this really expanded the narrative as to who a firm should pay attention to. And this gave rise to the idea of stakeholders. And so Ed Freeman defined stakeholders quite broadly as any group or individual that affects or is affected by the firm, or any individuals or groups with an interest, claim, or stake in the company. And the way we typically think about stakeholders are internal stakeholders, which include stockholders, employees, executive officers, other managers, and board members, individuals that are within the organization, and external stakeholders, and those include all the other individuals groups that have some claim on the company. Now you can imagine that this can get quite messy when you're trying to think about who the firm affects and who is affected, who the firm affects and who affects the firm. And so there's been a lot of discussion about how do we understand the way in which firms should interact with stakeholders, particularly in instances where you're going to have conflicting demands. And so one way of thinking about it is this stakeholder impact analysis. And it's a process which begins by identifying stakeholders along with their interests and concerns, identifying the probable claims of stakeholders on the organization, and then identify the important stakeholders from the organization's perspective. And from there, you can identify a strategy that minimizes the most significant or the most egregious conflicts that can have potential effects. As I said, this is something that I've thought a lot about, and one of the questions that I have about this kind of model is that it makes the interesting assumption that firms themselves are in a position to recognize which stakeholders are more or less relevant. And the real problem with that is trying to understand a situation in which there's a salient stakeholder group that the firm sees or recognizes as salient, but isn't doing anything to address the claims of that stakeholder group. What typically happens is that there are stakeholder groups for which the firm is unable to see for a variety of different reasons. It may be due to biases of managers. It may be that this is a stakeholder group that communicates differently than the firm normally pays attention to, so for a variety of different reasons. And so I would suggest that the firm itself being able to recognize its legitimate and salient stakeholders is particularly challenging. And so there are different additional tools or considerations that firms need to make in trying to understand who are the relevant and irrelevant stakeholders. The other challenge or criticism that I have with this approach is that it really views responding to stakeholders in a very instrumental sort of way. This idea that the only stakeholders that really matter are the stakeholders in which I can benefit from, or that I perceive that I benefit from. And this is problematic for a number of different reasons. The first is this idea that if you're only going to engage in relationships in which you have a clear and monetary benefit from engaging with, it's going to be very difficult to make a lot of friends. That as human beings, we tend not to like individuals and groups that are that sort of functional in how they interact with people. So that's one problem. The second problem is that there are stakeholder groups who they themselves may not be in a position to have much of an effect on the firm, but they may have a relationship with another stakeholder group which can have a significant effect on the firm. So, for example, one of the interesting things to think about is that the natural environment in and of itself isn't going to make any actions against a firm. The forest itself isn't going to cause the firm to go bankrupt. But there are certainly friends of the forest who may be potential customers, regulators, lobbyists, and so in not addressing the concerns of the forest, who itself doesn't have any direct effect on the firm, there may be other stakeholder groups, the lobbyists and the environmentalists, who are concerned and who may have a negative, may engage in actions which can have a negative effect on the firm. I think the part of the challenge with this stakeholder saliency modeling is that the best strategy really does seem to be to treat all stakeholders, regardless of the influence or effect that they may have on your firm, fairly. And that addresses a lot of these problems of trying to figure out how important this stakeholder group is or how salient it is. And then the other thing to keep in mind is having mechanisms in place in which to hear feedback from stakeholders. How to listen to different groups and avoiding the sort of corporate isolation that can happen sometimes. Now, the other idea that this textbook promotes, and we'll talk a bit more about it at the end of the lecture, is this idea of stockholder supremacy. And the idea behind stockholder supremacy is that stockholders receive a return on their investment either through a dividend payment or capital appreciation in the market value of a share. And so the idea is that investors come together to invest in a company with the explicit intent that their investments are going to have some return. And that return is either through dividends or through the capital appreciation of their stock value. The only way in which a shareholder can receive dividends or increased appreciation of the market value of their share is if firms increase their value. And the way that firms increase value is through profits. And what we've been calling value capture throughout the semester. And so if we think about the ways in which a firm can grow its profits, it can do so by participating in a market that's growing, taking market share from competitors, consolidating the industry through horizontal integration, or the development of new markets through international expansion, vertical integration, and diversification. And the interesting thing here, as you can see, is this is basically a summary of what we've discussed throughout the semester. And so the model very much here is how do firms increase opportunities for value capture. What's missing from this narrative here is that the only sustainable way, and we'll again talk more about this at the end of lecture, that firms can continue to capture value is through some value creation mechanism or process that they're engaged in. So that's the general idea, and the argument for why shareholders are the owners of firms and why firms exist to maximize shareholder wealth. It's because shareholders made an investment in the firm, which is considered a buying the firm, and then therefore, because they made that a financial investment in which it incurred some risk, that shareholders should be awarded any residuals or profits that a firm makes. Now, this presents a very interesting question, which we call the agency problem. And so agency theory is this idea that deals with business relationships when decision-making authority is delegated from one person to the other. And within the kind of the primary way in which this is considered is the relationship between stockholders and senior management. This idea that stockholders are principals or owners of the firm, and that senior managers are hired as agents to represent principals and make decisions about the firm. And so you have this separation of ownership and control. So agency theory can recognize any situation in which there's a separation from ownership and control, but the primary way in which it's considered is the separation of ownership of shareholders and management of the firm. And so graphically, we can think about it this way, in that you have principals, the shareholders, who hires agents and also responsible for monitoring and compensating those agents, and that those agents perform work, provide time and talent on behalf of the principal's interests, and that there's information asymmetry and other problems that may incur because of this separation between ownership and control. And this is essentially the agency problem. So the information asymmetry, that an agent has more information about the resources being managed than the principal, and so in order to avoid problems or abuse of that information asymmetry, there are laws for monitoring agents, the co-determination law, Securities and Exchange Commissions, and generally agreed upon accounting principles. The other agency problem that can occur is on-the-job consumption, so a situation in which senior management use company funds for their own benefits at the expense of the shareholders. And this was, one of the prime areas in which, when we talked about diversification in the last lecture, when we talked about, the wrong kinds of diversification. So diversifying simply to make your company larger, and the idea is that larger companies, if you're a CEO of a larger company, that carries more prestige, generally has a higher salary, more authority and power, but that does so at the expense of investors. And so this empire building, buying new businesses to increase the size of a company through diversification, is a kind of on-the-job consumption in which managers are misallocating resources in order to benefit themselves at the expense of the investors. And so a lot of the agency problems, or a lot of agency theory, is trying to figure out ways in which to reduce these sorts of problems. The other issue that we have with agency problems, or that can exist, is there is an inherent trade-off between short-term growth and long-term growth. We can talk about the revenue growth rate and long-term profitability. The idea being that you can that these are somewhat orthogonal in nature, such that if you maximize revenue growth, that you do so at the expense of long-run profitability. If you only focus on long-run profitability, that you sacrifice some revenue growth opportunities. And so, one of the strategies, or one of the issues that we're concerned about with agency theory, is how to make sure that managers allocate resources along this line in such a way that maximizes the benefit for shareholders. And implicitly, the argument is that managers, because of their short-term orientation, may be more interested in maximizing revenue growth rates at the expense of long-run profitability. And so part of what agency theory tries to get at is how can we get managers to think more about long-run profitability rather than focusing on revenue growth at the expense of long-run profitability. And so that's the challenge for the principles, shaping agents' behavior to act in accordance with the goal set of the principles, reducing the information asymmetry, and developing mechanisms for removing agents who do not act in accordance with the goal. So again, this idea of how do we get these agents, these senior level managers, to act in the best interest of shareholders. And that's where these governance mechanisms come in. And so these are used by principals to align incentives with the agents, to monitor and control agents. And this includes things like boards of directors, stock-based compensation, financial statements, and takeover constraints. So let's dive into each of these here a little bit. So boards of directors, we typically understand boards of directors as including inside directors, senior employees of the company, and outside directors who are not full-time employees of the company. And the idea is that you want to have a balance of both. That inside directors are going to have more of an in-depth understanding of the company. They work at the company full-time, and so they know it quite in-depthly. But you also want to have some outside directors to provide some objectivity in monitoring and evaluation of the process. Now, stock-based compensation is one of the kind of dominant models or mechanisms that has been used to align senior level management with shareholder interests. And the idea is providing compensation that includes stock options. And stock options are the right to purchase a company's stock at a predetermined price at some point in the future. And so the idea is that when you're hired by a company, that typically what happens is as part of that hiring, you're given the right to purchase so many shares upon leaving the company at the price at which the stock currently is when you start. And the idea is that then, as a CEO of a company, you have an incentive to grow the stock price of the company during your tenure, because the difference between the set price and when you choose to act on those options is profit in your pocket. And so the strike price is the stock's trading price when the option was originally granted, and this motivates managers to adopt strategies that increase the share price of the company. Now, this has become wildly popular in most publicly traded companies. The bulk of CEO compensation is now in stock options. And part of the reason that this has become so controversial is that it's led to a radical divergence in CEO pay compared to average employees. And so to give you guys a sense, in 1980, the difference between a CEO's pay and the average employee was 40-1. So a CEO made 40 times as much as the average employee. In 2012, that grew to 300-1. And I'm sure that number has increased even more in the last 6 years. And this raises a very tricky question, in that for me it's very difficult to understand in any way, shape, or form how the CEO of a company creates more value or creates as much value as 300 average employees in the company. To me, that seems like a pretty dramatic difference. And what's interesting is there's been a lot of research that has been done to kind of look at how much value do CEOs really bring to companies? And interestingly enough, that's been a very difficult question to answer, and there's been a number of different kind of estimates that have been given, but none of the estimates that I have seen come anywhere close to such a significant valuation or difference or effect on a firm's performance of a CEO. And similarly, the average CEO pay for a Fortune 500 company is around $11 million. So when you think that the average household income in the United States is about I think it's about $32,000, that sort of dramatic difference is really difficult to explain and justify. But part of the reason why firms have been able to offer these significantly large salaries is because the firm itself doesn't actually have to pay for these salaries. It's paid out of equity, and so there's no capital requirements that are needed in order to give these large salaries. It's the shareholders themselves, through dilution of equity, that end up paying it. And so it's an interesting way in which you can offer CEOs these large salaries without actually having to put up the money to pay them. But it doesn't result in some significant inequality issues, and also raises questions about how shareholder values are shareholder value is really being created, because again it's difficult to justify these large salaries. But ultimately, the idea of these programs or this model of stock-based compensation is to align management with stockholder interests. Similarly, the financial statements and auditors, so this is primarily focusing on the issue of information asymmetry, and so the quarterly and annual reports of publicly traded companies are filed with the SEC to give accurate information about the way agents are running the company, and that the SEC requires that accounts be audited by an independent and accredited accounting firm to make sure that the managers are not misrepresenting the financial information. Now, one of the strange questions that I have about this idea is, do these reports really provide an accurate portrayal or picture of the company? We've seen time and time again the creative ways in which companies can manipulate these financial statements to present quite opaque narratives. This is exactly what Enron did. But what's interesting is that there's nothing illegal about, explicitly illegal about what Enron was doing. It was just creative interpretations of existing laws. There are other situations, Amazon, while they do give financial statements, it's very difficult to understand what Amazon is doing based on their financial statements, because they only provide the very bare minimum of information. Again, really raising the question of how helpful these tools are. The other question that I have about these financial statements and reporting is this question of, are we creating these financial fictions that may exist on paper but don't exist anywhere else? And that was a bit of the problem with the financial crisis in 2008, is that we had created all of these fictitious financial instruments that didn't exist in any sort of real reality, but firms were able to put them down on their financial reporting as assets, grossly overvaluing the value of these companies, driving up stock prices. So again, I understand the need and the reasoning behind this sort of work, and where my criticism or arguments fall apart is I don't have an alternative tool, but I do think it's important to kind of look to these with somewhat of a more critical and skeptical eye than we sometimes have in management. The other strategy in which to ensure the alignment of management and shareholders are takeover constraints. And so firms that are poorly managed, their stock price is going to go down. And if there is an investor who recognizes the undervaluation of that firm, they may be tempted to acquire the company. And so there are these corporate raiders who purchase large blocks of shares in companies that appear to be pursuing strategies inconsistent with maximizing shareholder wealth. And so these corporate raiders, the idea is they want to purchase enough shares, maybe not necessarily to take ownership of the firm, but to have enough ownership to pressure management to change directions. So the green mail pushing companies to either change their strategy to benefit stockholders or charging a premium for the stocks when the company wants to buy them back. So kind of leveraging the stocks to force management to align their interests closer with shareholders. Now, there are also governance mechanisms inside a company, so these strategic control systems, and these are formal target setting, measurement, and feedback systems that establish standards and targets in which performance can be measured, to create systems for measuring and monitoring performance on a regular basis, and comparing actual performance against established targets, and ultimately evaluating the results to take corrective action as needed. So it's very interesting, if you talk to different business managers in different industries, they all kind of have these different ratios or metrics that they use in order to measure success or performance in their industry. So in the restaurant industry, some of the folks that I know in the restaurant industry, one of the things that they keep close tabs on, is tabletops served per night. That's an important metric for them to pay attention to. And if that fluctuates or deviates from what they expect, that's a signal that there is a problem. Other industries, it may be something related to inventory turnover, or return on inventory. Again, there are all sorts of different metrics that different managers and CEOs in different industries keep tabs on. But the interesting thing is every successful business that I have had an opportunity to inquire about this uses these ratios quite. They pay very close attention to them. Sometimes on an hourly basis, sometimes on a daily basis, but they definitely pay very close attention to it. Another kind of internal control is the balanced scorecard. So this was even more popular a couple of years ago. It's somewhat fallen out of favor, but the general idea behind the balanced scorecard was to look at how firms affect different stakeholder groups, and then being able to assess where the specific conflicts were, in order to balance the cost and benefits that are borne by each of the different stakeholder groups, with the idea that if any individual stakeholder group bears the brunt of the cost, that you're likely to have problems. And so you want to make sure that no single stakeholder group bears an unfair burden or accrues an unfair benefit in comparison to the other stakeholder groups. And so one idea to kind of address that problem is this idea of a balanced scorecard. Part of the problem with this model was that it's very easy to kind of not fudge the numbers, but make it work. When you're putting it together, when in practicality or when in reality, that there are significant problems. And then the other thing is as I talked about earlier with the stakeholder saliency, this is only helpful if you've got the most salient stakeholders on your list. And so if you're doing this and you've omitted an important stakeholder group, this is perhaps a less helpful exercise. So some of the reasons why it's fallen out of favor. Employee incentives are another internal control mechanism. Most commonly under the kind of banner of pay for performance. And the idea is to motivate employees to work towards goal-centered and maximizing long-term profitability. And so this can include, employee stock options, stock option grants, or bonus pay, or working on commission, these sorts of tools. Again, one of the really interesting things that folks are starting to ask is a lot of these, employee incentive programs or pay for performance programs have the effect of increasing anxiety amongst employees. And there was just a thing I was reading the other day that started to ask the question, have we put ourselves in a situation in which we're making our employees sick because of our incentive programs? Are we making them so anxious that they're no longer able to perform at the level that they're capable of performing because of the anxiety-inducing pay for performance? Another interesting question that this pay for performance story neglects to consider is that there's been a lot of really interesting research on what motivates people. So Daniel Pink is a guy who's spent a lot of time talking about this. And one of the arguments is that extrinsic motivation tends to demotivate creative thinking. And so one of the arguments that Daniel Pink makes is that most firms, the work that they need is creative problem solving. And that pay for performance has a negative relationship with creative problem solving. And so we may in fact be using these tools in ways that have negative effects on performance. So interesting things to think about. We're going to switch gears here and talk a little bit about ethics and strategy. And again, this is the perspective of the textbook. One concern or comment that I have about this is, adding in ethics as, a section of one of the last chapters in the textbook, to me kind of raises some questions about how much ethics is really valued by the authors of the textbook. That why haven't we been talking about ethics throughout the semester and integrating this, or at the beginning of the semester, and integrating this into our thinking throughout the semester as we've been talking about these things. And I would suggest, and as you'll see a lot of the examples of how they of how you include or how you make ethical decision making in businesses, is very much this add-on strategy, that you do everything normal and then you add on some sort of ethics control mechanism, rather than considering ethics from the beginning. But let's get into this. So ethics, I think we understand generally what we're talking about here. These are the accepted principles of right and wrong that govern the conduct of a person, the member of a profession, or the actions of an organization. So business ethics are the accepted principles of right or wrong governing the conduct of business people. Most interesting, though, are ethical dilemmas, and I would suggest that very few of you will face very many ethical issues, but most of you will face an ethical dilemma. So an ethical issue is a situation in which there's a clear right and wrong, and you choose the wrong choice. Most of the time, what we see are situations in which you've got two values that can't be pursued at the same time. And so what do you do in that situation? And kind of the perennial ethical dilemma is, when my wife asks, how does she look in a new outfit? Do I maximize on the value of honesty, or do I maximize on the value of supporting my wife? In some situations, I can't do both at the same time. And so that's an illustration of an ethical dilemma, a situation in which you have conflicting values and you have to choose between one of those. And so, part of it is having mechanisms or systems in place in order to help you navigate and make that decision of an ethical dilemma. But one question to ask before we get into that is do firms really do well by being good? Is there a corporate benefit in being ethical? And there's again a lot of interesting research that's been done on this, and there are a lot of factors that make this a much more difficult question to answer. But there are indeed a number of reasons why this might be true. One of them is regulatory freedom. So this idea of the social contract. So this idea that firms exist in order to perform some function in society, and if they have a negative function in society, that they are going to be regulated, either explicitly or implicitly. And what we know from the research is that reactive firms are forced into compliance. So firms that engage in some sort of value destruction in society and don't actively work to remedy that will eventually be regulated, and that regulation will force them into compliance. Whereas proactive firms define compliance. So firms that are looking to ways in which to reduce the negative costs that they have on society oftentimes get to set the terms or the standards under which other firms in the industry must also reduce their negative effects on society. And if you remember our discussion from a couple of weeks ago on standardization and the importance of winning standards wars, firms that set the standard for how compliance is met are going to have a competitive advantage over those firms that must adapt to the standards that are set. Another way in which firms benefit from ethics is this generation of and stock of goodwill, and this relates to attribution of blame. And so, stakeholder trust. So different investors, suppliers, and employees are likely to trust firms that have a track record of acting ethically, and are likely to distrust firms that have a track record of acting unethically. And this is important in situations in which you need the benefit of the doubt. And so, let's take the example of the Deepwater Horizon oil spill. So with a incident like the Deepwater Horizon oil spill, it can be really difficult, complicated, and ambiguous to identify the level of responsibility that British Petroleum, or BP, has for that oil spill. And if the case goes to court, the jury is going to have a very difficult time objectively identifying the level of blame or the level of responsibility that should be attributed to BP. However, one of the things that they can do very easily is gauge how much they trust the company. And so if the company has a good track record of being a community player, then the jury, and in some cases the jury of public opinion, is likely to believe that the reason that the incident occurred was random error. It was an act of God. It was nothing BP could have done could have prevented it, and it's a tragic, sad accident. However, if BP is seen as a bad actor, that they are seen as unethical, it's more likely that the jury is likely to say, well, this was probably your fault. You probably didn't do something that you were supposed to do. And so even though in the specific incident they may be unable to attribute the specific amount of blame or responsibility that goes to BP, if the company has a track record of being unethical, they're more likely to be held accountable for more responsibility than if they have a positive track record. And this definitely, for firms that go above and beyond the standard, can have some pretty significant effects. So one of the really interesting stories is about Ben & Jerry's. So Ben & Jerry's, they had a very strong reputation of being a good social actor, but during, before Ben and Jerry's was sold to Unilever, they made a number of critically poor strategic decisions that put the company in financial peril. And so ultimately, what happened was in order for Ben and Jerry's to continue operation, that it was clear that they were going to need to be bought out, that they were going to need an injection of cash from a large investor, and ultimately be bought out by one of the big food companies. But the story that a lot of people believed was that there's no way that Ben and Jerry's could be a bad business. There's no way that such a good company that is so friendly and so good to so many communities can be poorly managed. And that the only explanation for Ben and Jerry's having to be bought out was because of corporate greed from Unilever. And so, it's kind of created this whole mythology behind Unilever's greed and how they destroyed a great American company, when in reality, the reason why Unilever was able to purchase Ben and Jerry's was because of poor management. So again, interesting ways in which goodwill and stocks of goodwill affect how we view firms. And then the final reason why being an ethical and moral company is potentially relevant is the tragedy of the commons. So if there is a stock of public resources that becomes depleted, that can be quite costly for different companies to deal with. And so one of the great examples that we're seeing right now is that the ski industry across the globe is very concerned with climate change. And there have been a number of different models and predictions that have really put up into question the viability of a lot of the world's ski resorts. So ski resorts, they use a lot of energy. They use a lot of energy in making snow. There's a lot of energy in running chairlifts. There's a lot of energy in getting customers up to the mountain, transportation. And so while the ski industry is not responsible for all of the greenhouse gas emissions, they're not responsible for the bulk of the greenhouse gas emissions, there has been a significant effort by the ski industry in order to reduce their greenhouse gas emissions, because they recognize that if climate change isn't addressed, that it's going to have significant negative effects and possibly decimate their industry. So, again, reasons why there is potential value in being an ethical company. Some of the issues in strategy are the conflict of interest. So the conflict between the goals of the enterprise and the goals of individual managers, and the fundamental rights of important stakeholders. And there's also this idea that the textbook introduces of noblesse oblige. This idea that so people of high birth have to give something back to society that made their success possible. So I'd never heard of this idea of noblesse oblige as applied to corporations, but I have heard of a related idea that I briefly mentioned earlier, this social contract. And so up until very recently, the primary understanding of businesses by society was that businesses were institutions that performed a function in society. This idea that they were profit maximizers is a relatively new idea. And so, in order for firms to exist, they have to provide some function in society. And if they no longer provide that function in society, society has an obligation to redact their rights of incorporation. So again, some ideas to think about. The textbook goes through and lists some of the rights of the different stakeholders. These are the rights that the textbook thinks stakeholders may have. You can go through and read these. Now the next interesting turn that the textbook takes is this idea of unethical behavior arising from agency problems. And so the argument that they're making here is that these are specific ethical issues that exist because of the separation of the ownership of the assets and how those assets are used. And so these include things like self-dealing. So when managers use company funds for their own personal consumption, information manipulation, anti-competitive behavior, opportunistic exploitation, substandard working conditions, and environmental degradation and corruption. And so the argument that they're making is that what happens in these instances is that you have various conflicts of interest, and that leads to these problems occurring. And so again, using the agency lens, the argument would be that what we need to do is reduce the distance between agents and principals. And so we'll go into in just a second as to why that might not necessarily be the best strategy. The textbook talks about the roots of unethical behavior, and they argue that personal ethics, the generally accepted principles of right and wrong governing the conduct of individuals. And while I'm not going to say that personal ethics don't play a role in unethical behavior, I would suggest that this is actually quite a small reason for unethical behavior of organizations. That in order for organizations to behave unethically, it often requires the cooperation, collusion, or at least explicit knowledge of such behavior occurring of others. And so, I think personal ethics alone is perhaps not a sufficient enough explanation. And so other factors that we have to consider are failure to ask oneself a decision is ethical. So do I speak up? I see something wrong. Do I say something about it? And so failure, this kind of assumption that it's not my problem. So that's one. And that in some organizations, the culture de-emphasizes business ethics. And there's actually been some interesting research that's been done on the culture of Wall Street. And one of the interesting findings is that there is a kind of institutionalization of day traders and different financial analysts to make them act more or less ethical. That these young green folks that work for these big finance companies are too ethical, and so there's a whole whole set of language and behaviors that are used in order to encourage folks in the finance industry to behave less ethically. Pressure to meet unrealistic performance goals and unethical leadership. And so one of the amazing findings of research has been that the influence of organizational leadership on the ethical tone of an organization is quite large and quite significant. And so if employees see top managers behaving unethically, then employees are also likely to follow that lead and engage in unethical behavior. So behaving unethically, how do we behave ethically? How do we change some of these things? The textbook talks about, hiring and promoting with a sense of ethics. So who gets promoted? Who gets hired to your company? If there's a very, successful salesperson who has a history of sexual harassment, hiring that person in order to benefit from their sales potential with the explicit knowledge that they have a history of sexual harassment is likely to not only cause problems with that individual in your company, but sets the tone that this is the kind of behavior that we look for in our company. And so, the ways in which, bad apple can make the whole barrel rotten. Building an organizational culture that places a value on ethics, the codes of ethics, formal statements of ethical priorities, ensuring leaders practice and preach ethical behavior, ensuring people consider ethical dimensions of various decisions, having ethics officers as part of your organization, putting strong governance processes in place, and acting with moral courage. excuse me. So this idea of doing the right thing even when the right thing is difficult to do. Now, some of the challenges and shortcomings of strategic ethics, some of the things that you have to consider, and so these might be some interesting reasons as to why, what we consider ethical business behavior may in fact be problematic. And one of them is the inherent tension between short-term and long-term value. This idea that by doing something that benefits tomorrow at the expense of today, that you're making a decision. Or doing something that's good for tomorrow at the expense of today, again, you're making a decision, and that decision has implications. The other argument is, should only social activities that firms engage in be those with demonstrable profit opportunities? So we talked about the reasons for which firms should behave ethically, why ethical behavior can lead to better firm performance. But the question is, should firms only engage in ethical behavior that has a direct link to firm performance? Or should firms do the right things even when it's costly for them to do so? The unintended consequences of filling institutional voids. So this is an interesting idea that I came across in my work with social entrepreneurship. But there's this great story about Tom's Shoes. And many of you are familiar with Tom's Shoes. It's an American apparel company that was really created with this social mission in mind. And the idea with Tom's Shoes was that if you bought a pair of shoes, that they would donate a pair of shoes in a community in need. And again, this sounds like a great idea. I buy shoes, somebody who needs shoes gets a pair of shoes. It's a win-win situation. But the problem was, in a lot of the communities in which Tom's was donating shoes, there was an existing shoe industry. So maybe the shoes weren't as good as the ones that Tom made. Maybe they were very expensive, but there was a shoe industry in place. And so when Tom's Shoes would come in and they would donate all of these shoes, it would put the local shoemakers and shoe sellers out of business. That they could no longer compete against free shoes. And so once the Tom's Shoes wore out and it was time to get new shoes, that local shoe industry had disappeared. And so there were kind of two costs to giving shoes that cause problems. One is you put local businesses who are going to reinvest in the local community out of business. And then the second is that you created a situation in which these communities became dependent on Tom's Shoes for basic needs. And so that's not a sustainable approach either. And so, I'm not saying that what Tom's Shoes did was morally or ethically wrong. I think Tom's Shoes started from a really good place. The problem is that in many of these instances where we think we're doing something good, we may in fact be doing something harmful. And so we really have to think about our benevolent acts and make sure that these benevolent acts have real long-term sustainable value creation. This is an issue that's come up a lot in volunteer tourism. So there have been a lot of critics of volunteer tourism who have started to ask, whether volunteer tourism really does benefit local communities. And the evidence is really mixed. There's some evidence to suggest that volunteer tourism has negative effects on communities in which the volunteering occurs. So again, some interesting things to think about. The other thing is this idea of good production of bad products. So kind of using an extreme example, is producing methamphetamines with less environmental waste better? This idea of cigarette makers making cigarettes with less tar, is that socially responsible? And it raises this question that there may be some industries in which engagement at any level is unethical, and that there's no way in which you can be more or less ethical in those industries. And I don't know. I don't have an answer for that, but I think it's an interesting question to think about. How deep in the value chain are firms responsible for? And then the conflicting and ulterior motives of different actors. So this idea in which, do firms who act good in order to benefit themselves, should they be, given this sort of praise that companies that act good for selfless reasons. And there's an interesting example of the soda companies, who are the biggest sponsors of recycling programs across the country. But the real reason that they're interested in sponsoring recycling programs is because they don't want anyone to pay attention to how much waste they produce. And so it's this idea that if we're recycling, then the fact that we have an empty plastic bottle doesn't really matter. When in fact, there are some serious conversations that maybe should be had about how the packaging industry is designed and organized, and that they while they may be sponsoring recycling programs, they're doing so to mask the packaging issue. So some problems with agency theory here. So the one thing that I want to kind of argue is, despite the fact that we say time and time again that in business classes and in the popular media and in conversation that firms are owned by shareholders, there's in fact very little empirical evidence to suggest that this is true. There's very little legal standing on which this argument can be made. The few cases in which this has been tried in various courts, there is definitely clearly a legal responsibility between firms and shareholders, but the idea that shareholders own firms is not been answered by existing case law. So this idea that shareholders own firms is problematic. And it's a relatively new idea. This is really something that only emerged, really took dominance in the late 1980s, 1990s, with the kind of hostile takeover movement. But the kind of broader argument as to why shareholders may not be the owners of the firm is that the argument that shareholders are owners of the firm are that they make an investment in the firm and thus bear the risk in which the firm and so therefore are claimants of the residual. But this suggests that no other stakeholder group makes an investment in a firm. And that's not true at all. Employees invest in the companies that they work in. Customers make investments in the companies that they buy from. So this idea that suppliers invest in time, energy, and effort with the companies that they work with. And so this idea that shareholders are the only stakeholder group that make an investment in the firm is somewhat short-sighted. Alternatively, even if we are to for the sake of argument, to argue that shareholders are the owners of the firm and therefore firms exist in order to maximize shareholder wealth, the problem is that shareholders are not a single interest group. That there's diverse interests and motives for investing. That some people invest for short-term profit growth, some people invest for long-term growth, some people invest in companies because they believe in the mission of the company. Some people invest in companies because they really like the products and want to be a part of the company. So there are all sorts of different reasons for why people invest in companies. And so this idea that investors are a single interest group is also quite short-sighted. The other problem that I have with this agency theory is that it creates opportunities for abuse that are far greater than the problems that we're trying to solve. And part of that is, if you treat people like cheaters, they end up cheating. And so we've seen all sorts of really interesting ways in which the stock option compensation programs have pushed CEOs to think even less in the interest of shareholders than they were when they were salaried employees. And so there have been all sorts of ways in which it's been argued in which you can make stock options a better tool to better align CEO motives with shareholders, creating more complexity in the system, creating more opportunities for CEOs to abuse the system. And so, my argument or my feeling is in part that this idea that what we need to do is reduce the the gap between owners and managers of different assets is when we do that in these sort of fictitious ways, we may be creating a situation in which the medicine is worse than the sickness, and that maybe this is not the strategy to move forward. The other interesting thing to think about is that there is a radical decline of publicly traded companies, that the number of publicly traded firms in 1976 was about 4,500 to about 3,500 in 2016, or about a 15% drop in the percentage of firms that are publicly traded. And this trend has continued moving forward, leading many business experts to predict that sometime in the near future, that publicly traded companies will be a minority of companies, that they're already increasingly a smaller and smaller percentage of the companies that exist. And interestingly, most of the new publicly traded companies over the last decade have emerged in models in which it's very difficult to argue that they really are publicly traded companies. So, if you look at Google and Facebook, if you look at how their stocks are set up, most shareholders have zero voting rights for the board. And most of these companies, if you look at their board, it's primarily internal board members. And so those external board members that were supposed to exist to give oversight are fewer and fewer. And so, again, this question of if are we solving a problem that is no longer relevant? And then the other issue that I have with this agency theory is, Enron management was great for shareholders until the day that it wasn't. And so this idea that what's good for management is good for shareholders, until something happens. So I'm less convinced that this is a strong strategy. Another issue is this idea of profit maximization. And so there's an argument that profits are only meaningful when understood as a return. And so when we talk about firms exist in order to maximize profits, well, let's take the situation in which you have a firm which has a $100 profit and you have a firm with $10 profits. You would sound like the firm with $100 profits is the more interesting company. But in fact, when you consider that it took $80 of investment in order to generate that $100 of profit, you only have a return on investment of 25%. In contrast, that firm that had $10 profit that only took $5 of investment has a return of 100%. And so which of these two is the more interesting firm to invest in? Well, it's the firm with the higher rate of return. So regardless of the total amount of profit, it's the rate that's interesting. And so that can sometimes get lost when we talk about profit maximizing. The other issue is when most people say profits, what they really mean are short-term returns on investment. But what is short-term? And we've talked a little bit about, the time value of money is inherently subjective. And so when we say firms, maximize profits, they can maximize profits, but over what time period? And what we would consider an appropriate amount of time can vary dramatically from individual to individual based on the situation and their personal preferences. The other idea is that if firms capture more value than they create, then they become a drain on society. And so this is, instances in which firms are acting unethically. And so this is, what I've tried to kind of push throughout this semester is that it's important for firms to capture value, but only if they're capturing less value than they're actually creating. And that if they're capturing more value than they're creating, then they're likely to be unsustainable. They're likely to incur high costs of regulations. And then, the other idea is shareholders have multiple interests. And so a firm that captures more value than they create, a shareholder, shareholder who lives in a community that's polluted by a firm, a shareholder who's an employee of the firm, or a shareholder who's a customer of the firm. If I am a shareholder of a firm and I live in a community, would I rather my share price go up, 0.2%, or for the company not to pollute my community? If I'm an employee of a company, would I rather that my share price, go up, a fraction of a percent, or that I, don't lose my job, or that I'm working in safe working conditions? And so again, this idea that shareholders are this unique interest group that diverge from interests of other stakeholder groups is most likely a fiction, and that in reality, shareholders have other values. It's really interesting to me that most of our pension plans are through investments in stocks, and so folks that have these investment plans, these retirement plans, that want their retirement plans to grow, but in growing their portfolio, the value of their retirement plan, companies were offshoring jobs. And so, you're in a situation in which, it's great that your retirement plan is increasing in value, but it sure be nicer to have a job today. The other issue that I want to briefly talk about is this idea of share price as a measure of performance. And some folks have argued that given the complexities of managing a firm, having a single goal allows for measuring progress. And it's based on this idea that there's an inability to maximize on multiple dimensions. And part of the problem with this idea is it assumes a zero-sum game. So it assumes that in order to, if you increase, environmental protection, that you're going to reduce stock price. And the reality of it is, that we need to think more in systems terms, and we need to understand the complex web in which different decisions affect firms. And so, a model to think about is, typically we've thought about business in this very competitive sort of a way, and that you want to be the biggest predator, in your area, and so you want to kill off all the other predators. Well, what's really interesting is what we know about population ecology is that what makes any individual in the community healthy is a healthy community, and so this systems approach is perhaps more relevant. This idea that stock prices are close enough to measuring value potential. Again, there's so much evidence to suggest that that's probably not true. But I think the most egregious error in this idea of share price as a measure of firm performance, and that you want to maximize on share price, and that you need to have a single, maximize on a single dimension, is that there's nothing natural about maximizing on single dimensions. I don't breathe at the expense of sleeping. I do both at the same time, and I'm certainly not healthy if I focus on just eliminating germs. In order to be a healthy individual, I have to have the right nutrients, and I have to get the right vitamins, and if I just focus on getting rid of germs, I'm probably going to get sick and die. So many of these problems deal with how we understand firms, and so what I want to leave with is this idea of is this question is, what if we reorient our view of private corporations and businesses as self-funded value creators? There's overwhelming evidence to suggest the dominant reason why entrepreneurs start firms is to create value. And even this idea of being self-funded is quite limited, as there's always public goods that cannot and maybe should not be privatized. And so maybe really what we should just look at is businesses as value creators, and that they're in the business of creating value, of taking raw materials, doing some production function on them that increases the value of those materials. I'd also suggest that that human beings are inherently social beings, and while we act sometimes with self-interest, we don't always act in self-interest. And so if we expand, this argument that economists often have is enlightened self-interest. So even when we're acting in the interest of others, we're only doing so because of the benefit to ourselves. What's interesting is there's just not a whole lot of empirical evidence to suggest that that's what's going on. And it doesn't seem to describe what people think or what people are doing. And so what I would suggest is let's take the assumption that people are inherently social beings, that we are small group mammals, and so let's start thinking about managing and organizing our firms in that way. And so the last thing that I want to leave you with is an example of a story of a company that maximized on shareholder value. And that was General Electric under Jack Welch. So on the previous slides that I skipped over there, there are a lot of ways in which Jack Welch managed GE in order to maximize shareholder value. And what's really interesting is in the 20 years or 30 years since Jack Welch retired from GE, what we've seen is that GE has consistently underperformed not only its competitive set, but the industry average, in that they have had negative performance growth over the last 20 years. And so this really suggests that many of the strategies that Jack Welch implemented in order to maximize shareholder wealth may have had significant advantages in the short term. In the long term, it is absolutely fascinating that that a company that was once the world's largest corporation is likely to disappear in the next couple of years. And I would argue, and I think that there's a lot of evidence to suggest that many of the reasons why this is occurring is because of the shareholder value maximization strategy that was pursued by Jack Welch. So even if you don't agree with me that we need to think about firms in alternative ways, I would suggest that there's a growing body of evidence to suggest that the old way of shareholder supremacy is unlikely to be sustainable. So thank you all very much for listening. Again, if there are any questions about the class, please feel free to post them on the student question lobby or email me. And like I said, probably will be a little break here before I post the next lecture. And we'll see you then. All right, thank you all very much.